It's such a pleasure to be here today and to share this case study that we've worked on for the past few months. So first, I guess, just as a bit of background, my name's Eric Nietsch. I lead the sustainable investing team for Manulife Investment Management in Asia. So you might be familiar with the insurance company, Manulife. I work on the investment management side. So investing in our public markets, bond and equity portfolios on behalf of Manulife, the insurance company, but also other clients. So it could be other insurance companies, endowments. Many of you may be invested in our strategies through the CPF. And Manulife, as a firm, manages about $1 trillion. And in Asia, we have quite a strong presence across 10 different markets in the region. So I work with our investment teams on the ESG integration throughout all of our portfolios in those locations, both the local currency single market portfolios, as well as the US dollar regional and global strategies. Manulife is, as a company, has been working and committed to sustainability for a number of years. Manulife is one of the largest owners of forests in the world, actually, largely through our heritage as a Canadian company, as well as a manager of a lot of farmland, both in the US as well as in the rest of the world, all of which is managed to very high levels of sustainability. In our investment portfolios, we look to fully consider ESG issues throughout the investment process. That starts with the data that we subscribe to and pull into our decision making. And so looking at platforms like STACS, thinking about how that influences valuations as well as the types of companies that we choose to invest in. But then we know that we need to go further. And so as active managers, primarily of long-only strategies, we don't have very many ETF products or passive products. We believe that the investment process has to continue past the decision to buy or sell. And so we'll work with the companies that we invest in to try and share the sustainability research that we've done and encourage them to address any risks and take advantage of opportunities. And there's a lot that we can do in our portfolios, but it's also really important that we recognize that we can't solve any of these big issues by ourselves. We need to come together as an industry. We need to work with other investors, academic institutions, the data providers, and companies like STACS in order to advance not just what we're doing in our portfolios, but in the industry as a whole. And so there's I'll talk just a little bit more about some of the methodologies that we apply to do this in our portfolios. So ESG integration is the consideration of the ESG issues, their valuation, and making sure that we're reflecting the proper risks and opportunities in our portfolios. In our sustainable strategies, we do believe it's also important to sometimes avoid certain activities. So that's the negative screening that Benjamin talked about, and making sure that we're not participating in those in our sustainable funds. But then we also want to make sure that we're including the positive screening. So actively identifying the companies that are performing really well on ESG issues, are contributing to the solutions and the changes that need to happen. And for fixed income strategies, we actually don't believe that a sustainable portfolio has to be only a green bond portfolio. We want to look at the entire market and the best opportunities and the best companies and bring that into the process more holistically. Now, that said, these can be very effective instruments for capturing impact and delivering that for our clients and achieving some of these outcomes that we're looking to in these portfolios. And so we do tend to overweight these kinds of instruments. But it's not always that easy, because what we're really looking to do with this is overweight the green and social bonds and sustainability-linked bonds, blue bonds, orange bonds, all of these hopefully growing kind of list of instruments, as long as they're credible. And that is actually can be quite difficult. So luckily we have primarily an actively managed, fundamentally driven research process, and we're able to form our own view on which of these instruments are credible, and try to provide feedback on those that might not be, or work with the companies and the issuers to make sure that this marketplace is being built with credibility and integrity. But I'll come back to this, because this is primarily what we worked on in this case study. The other pieces, just to kind of finish off the strategies that we can apply, are engagement, like we talked about. So after we choose to invest, continuing to work with those companies. And then what's shown here as positive impact, which is really about making sure that we're measuring the outcomes. So if all of these kind of strategies are working correctly, then measuring that making sure that we have metrics to show that the objectives of the fund are being met by the outcomes of the portfolios. So what we've done with STACS and with this case study was try to just focus in. We were able to look at the entire portfolio, a sample portfolio that we worked on together. But beyond the entire portfolio, we were able to focus in on the green bonds specifically from the real estate sector. And so with that, we were able to focus on doing ongoing due diligence and monitoring of the green bonds that we had deemed as credible. So to follow up on a further assessment for making sure that those were really credible. And that's why it's important that STACS is pulling together data and information that's verified and credible, and as bringing in certifications from third parties to really support that due diligence. And so this shows just a couple examples of how we were able to do that in more detail. We were able to, especially relevant to the real estate assets underlying the green bonds from real estate companies, we were able to look at the green bond certifications at an asset level detail. And that provides a greater level of detail than we usually get from the data providers. So a lot of times the ESG data that we will get from companies will be at the issuer level. And this makes sense. So if you think about how companies are in the habit of reporting information, they report an aggregate revenue line or an aggregate income statement. They don't necessarily give you the revenue that's associated with every single corporate asset. But what we were able to do here is actually look at all of the a lot of the assets that would be underlying those bonds and look at their green credentials and look at their certificates to add that assurance that these green financing instruments are really addressing what they're supposed to. We're also able to get updates, so automatically pushed through email to see if there's anything that's changing in the portfolio. And conduct further kind of monitoring and receive timely updates that way. And so I think in terms of and I should add that this level of information can also be useful when we're having those conversations with companies. So when we're conducting those engagement conversations, having this level of information can be really, we can bring that into the conversation and ask about what's happening at different assets or how different assets might feed into the company's overall targets and public commitments. So I think in terms of STACS and ESGpedia's kind of goal of building trust and integrity in ESG data, it's been a really interesting case study to work on together. So very, very happy to share it with you, and I think we'll be up on stage later for questions if there's any follow-ups. Otherwise, please feel free to catch me afterwards when Benjamin will be bartending. So, thank you very much.